Hi everyone, welcome to today's session titled Beating the Markets with Momentum Investing. In this session, we have Alok Jain from Weekend Investing. So Weekend Investing is a manager on the Small Case platform. And to give you a brief overview of what Weekend Investing has been doing so far and a brief background of Alok Jain himself. So Weekend Investing was the first publisher on the Small Case platform. And they were the first set of managers, small case managers, to launch their small cases live on the platform. And if we take a look at how Weekend Investing has been operating so far, their key focus area of their research is purely on momentum investing. And Alok Jain comes with 27 years of market experience. So Weekend Investing predominantly caters to retail clients, and the total number of retail clients have crossed over 16,000 as of today. And to give you more background about Alok Jain himself, he's a graduate from IIT Delhi and he holds an MBA in finance from the University of Maryland. And Alok Jain has also played a part in setting up one of the first NSE memberships in Delhi. So without further ado, I would like Alok Jain to take over from here and to maybe give us an overview of the philosophy behind how the small cases were designed. And maybe I would also request you to throw some light on how the portfolio performances have been so far, and anything more that you would like to add from your end, sir.
Thank you, Pranav. I'll just share my screen and we'll basically go from here. It'll take me about 40 to 50 minutes to go through this presentation, where I will essentially cover trying to break myths about how compounding can impact long-term performance, what are the common problems of new investors, why we do momentum investing, introduction to various strategies, their performances, and how we create them on the Small Case platform. So to start with, we want to essentially and thank you for the generous introduction. We have been given a lot of love by the markets in the last 5 years of operations. About more than 16,000 people have joined us and are continuing with our strategies, realizing over time that these simple strategies with very simple 2-minute involvement every week have been beating the market benchmarks and the conventional investing returns. So first, let's do some myth busting. A lot of people feel that a high CAGR or XRR is required every year, and 15%, 20% are not large numbers enough. Another myth is that making large amounts of capital over your lifetime is something that comes around with luck and cannot be created by most. Net worth of, let's say, 10 crores or huge investments are required to make a lot of money by the time you retire. And these are all myths, actually. I mean, if you actually go and see that even with very basic amount of returns, but with continuous compounding, you are able to reach most of these targets very easily. And I'll share this one simple chart with you. Here, what we have done is we've taken a lifespan of an investor going from, let's say, year 1 to year 30. So maybe you're starting out at an age of 25, 27, and then going on to about an age of 55 to 60. And you can see that even with a 15,000 monthly SIP, which goes up 5% year on year. So first year, let's say if you're doing 15,000 a month, and next year you'll do 5% more than that every month. And so in subsequent years, you will keep adding 5%. And assuming that you are able to generate 15% on your strategy that you've deployed, which, by the way, is not very difficult, actually. The way in the last 22, 25 years that I've been, 27 years that I've been in the market, 15% XRR would have been easily possible, but of course it requires discipline. So now if you do this math, you will see that to reach your first, let's say, first crore, it will take you 14 years. 14 years to reach your first crore if you keep investing 15,000 in the first year per month and then go up 5% year on year. But then look what happens from next year onwards. Your second crore comes just in 4 years. The third one comes just in 3 years. The fourth one comes just in 2 years. So you can see that the compounding, it's slow to start with, but once it does get going, it really goes very, very fast. And you can see that, by year 29, you're reaching a sort of a state where every year you're adding more and more and more. But this requires, great discipline, great patience, and sticking to your strategy. A lot of people will just quit, after their first drop that they see in the market. Mm-hmm. So journey to first crore is very important. The next ones will come easily, and the magic of compounding will happen around this. Now, the problems that I saw while I was running the brokerage for about 2 decades was I was able to see how these few thousand investors who were my clients, how they were dealing with their trading or investing. And I observed that, most of the people had very poor success rates, and most of the success was coming either purely by luck or by just coincidental timing at some points of time, but there was no consistency in those returns. And investors jumped from one strategy to the other, from one stock to the other, without any proper plan, without any position sizing. And essentially, those people who were following simple strategies and were able to do that consistently year after year after year, they were performing much better than those ones with ad hoc or discretionary strategies. And disciplined investors who were actually making good amounts had high conviction in their strategies and their processes. So the problems that I was able to see across thousands of clients was lack of patience, lack of discipline, lack of conviction, lack of a basic strategy, and lack of sticking to a strategy. Most people, jump strategy 1 to strategy 2 to strategy 3 as soon as some drawdowns happen. Now, what is a drawdown? A drawdown is nothing but a drop from the highest point that you've achieved in the past, which measures basically what would have been your loss had you entered at the highest point. So just a very simple example here. Let me just move this somewhere else. Okay. So you can see there are 2 strategies here. Both start at, let's say, an index of 100. And when this COVID drawdown came in March 2020, one strategy fell only, let's say, from strategy A, it goes down by 20% here. And this dotted line is strategy B, which goes down by 40%. So it was same journey for both of them till here. And only during this 1 month or 2 months period, the journey for A was -20 and the journey for B was -40. And the journey after April till today, if you assume that they were identical in both the strategies, the outcome, the final outcome is vastly different today. So both started at 100, both had a, same returns for this period. Only the 2-month return here was different. And the rest of the last almost 2 years was also same. Mm-hmm. But B ended at 257 index and A ended at 342. This much difference has come around because of the drawdown itself. So the lesson to be drawn out from here is that you need to have lower drawdowns. Choose strategies to choose your processes so that you can have lower drawdowns where you can immediately get up and start running again. The deeper you fall in a ditch, the more difficult it is to get out and start running again. So that is sort of the analogy that you can look for drawdowns in a strategy. Also, as I said earlier, the compounding magic that happens with time. You can see that over a couple of decades, there'll be so many, drawdowns that will keep happening. Market events like we're currently witnessing, or the COVID fall that we saw, or the great financial crisis we saw. But over time, with consistent strategy, your long-term CAGR will become flat actually. Here you are able to see a long-term CAGR on the Sensex over a couple of decades. And you are seeing that despite these huge drawdowns, of 40-50%, your overall long-term CAGR will not move much, because the impact of each year will basically reduce as you go deeper and deeper into your investment cycle. So essentially, come in with a long-term view, come in with a strategy that is self-sustaining, and come in with your capital gradually spread out over time. Now, what happens with discretionary investing, which most people do? I would say 99% people do discretionary investing, which means that you have complete discretion about what you want to buy, when you want to buy, when you want to sell, and there is no particular rule about it. So, you hear something on TV, or a friend tells you something, you buy something, it goes down, then you don't know what to do about it, and then you sell it out and you buy something else. So basically, there is no plan and there is no strategy. Now, what happens even if you were to sort of do this discretionary investing is that the variables are just too many. For instance, what universe of stock do you want to select? Whether you want to buy small caps, mid caps, large caps, which sectors you want to pick, what valuation methods will you use? There are so many valuation methods. You could use a discounted cash flow method. You could use a sum of the parts method. You could use comparables to other companies. How will you gauge management quality? That also changes with time. How much to hold? What is the time frame that you want to hold these stocks for? What will be the impact of liquidity flows? Let's say, for instance, last 6 months, FIIs have been selling in the Indian market. How is that impacting your stocks or your universe? What will be the entry and exit decisions, and how you will decide, or based on what factors those will be decided? How will you construct the portfolio? How much allocation you will do to each stock? How will you assess the risk of each stock or each sector within that? And then, of course, a lot of macros where interest rate cycles are changing, inflation is coming, changes in oil, currency, government policy. So many variables just keep on changing that particular equation, that it becomes almost impossible to deal with discretionary investing with any particular process. So momentum investing is one kind of a investing where it is essentially a rule-based investing. So the rules of the game are pre-decided, and I'll walk you through some of those. And what essentially it does is very, very simple, and you'll be actually surprised how simple this is. What essentially we are doing is we are buying what is going up and we are selling what is going down. By conventional wisdom, we are always looking for buying what is going down and selling what is going up. But this is actually the reverse of that. So we are essentially saying that the stock price movement itself will tell us where the strength of the market is, and the stock price movement itself will tell us where the weakness is getting generated. So that itself will sort of lend you to buy or sell stocks based on the strength and weakness in the market. So in simple words, let's say an example like Hikal. I mean, it was lying flat for almost 5-6 years, and then suddenly it started to move up. Momentum investing picked it up here, entry at 208, it went up to 700, it started falling, exit at 537, and then it has started falling again, so on and so forth. So basically what you've done is you've allowed the price to tell you where to get in, and you've allowed the price to tell you where to get out. And not having to have keep guessing all these years that when will the stock actually move based on what you may have perceived as value. So essentially, what are the rules? The four sort of cardinal rules or framework that we want to cover is what to buy, when to buy, how much to buy, and when to sell. And this is not just for momentum investing. Actually, you can build these frameworks for any type of investing, and these four pillars should be clear to you at any point of time. That what are you buying, how are you going to select that, when are you going to buy, how are you going to select that time, how much are you going to buy, that will be the position sizing or the portfolio creation, and when are you going to sell. So there should be simple rules around this, so that whenever, even in discretionary investing, when you are pushed against the wall with so many variables and you're not sure that whether the stock will come back or it won't, or just one external factor force has brought the stock down, so should I sell it? So that entire thing should be crystal clear to you, and that crystal clarity comes when there is no ambiguity in rule making. Another thing is something called the casino math. Now, what happens is a lot of people are, wanting that, if they take 10 investments, 90% of the investments should do well. It's okay if one does not do well. But here, what I'm trying to tell you is actually the reverse, where I'm saying, let's say two cases where, case A, there are 70% of winners, and case B, where there are only 30% of winners. Let's say you do 10 investments, and in case B, only 3 did well, and in case A, 7 did well. But in case A, the return of an average good investment was 25%. In case B, it was 90%. 30% were losers here, but return of average loser were, let's say, 65% each. And here, let's say it was only 20%. So what you can see is that just with this simple math, if you were to add these together mathematically, you'll see that the portfolio return here is still negative, despite having 70% winners. Whereas in this case, the portfolio return is a double-digit positive, despite having only 30% winners. So the casino math basically is that regardless of higher number of winners, you may have lesser winners, you may have 50-50, you may have 40-60, but each of your winners should win you much more than what each of your losers is taking away from you. So in this case, each win was getting you a 90% return, but each loss was taking away only 20% return. And then when you do this over a large number of iterations over investments, the actual result starts to come out on its own. So this is also a part of the entire strategy, where this keeps on sort of manifesting into better and better returns and compounding over time. Now, another aspect of momentum investing is that it is sort of emulating the survival of the fittest. So while, in regular investing, you never know whether your stock, which is down, let's say 30% from the top, is going the next 30 down, or is it going to go the next 30 up, or as the market structures are changing, as disruption is happening in some industry, who or what industry or what stocks are going to survive. And what price action does is that the price action actually leads this information. So, when stock is running hard, you actually know that, the market knows something more than what conventionally people are thinking. And the market always knows ahead. That's why, the BBC principle, Bhav Bhagwan Che, which we consider as our leading principle in momentum investing, is so successful, because the market always knows ahead. You would have noticed in your own observation also, whenever there are bad results of a company, the stock was already coming down for the last 3 months. Right. Whenever there are fantastic results of a company, stock is already going up before that. Whenever there's a announcement of some good acquisition or some positive corporate action, stock has already moved. And you're at that time thinking, why has the stock moved? And the news comes later. So the market always knows ahead. So what price action does is that it is able to tell you in advance what is actually happening, which are the strongest stocks in the market. So what you can see here is that, again, I'm just taking a few examples from the last year where, Hycal or Laurus Labs, we were able to pick at very low rates. And, once they started falling, we were able to get out at an early stage. So this is also an advantage where you are able to dump your losers or laggards early. This is another example from Amara Battery, where we were able to get out near about 900, and then it kept slipping on later as it came down. So what you want to do is, outperform when the market is going up, and you also want to outperform when the market is going down. This is very, very key actually to understand. So I'm taking here an example of one of our strategies, which is NNF 10. So this strategy is based on CNX 200 stocks, 10 stocks, and it is monthly rebalanced. And you can see here that this is in this period, in a downtrend where the benchmark went down from 100 to 67. So about a 32.5% drop on the benchmark, whereas the strategy was down only by 21.3%. So it has outperformed while the index was going down. And then when the market started to move up, the strategy went up 196 index versus 189 on the benchmark. So it outperformed on the way up as well. And when both are combined together, then you actually get that alpha where you really beat the benchmark. And I'll give you more examples on this. Another strategy, MI Evergreen, which is a very, very robust strategy with the hedge of gold in it, and I'll explain that later. Again, as the markets were going down from August 18 to March 20, the benchmark CNX 200 down again 29%, strategies down only 17% and on the way up, benchmark is up 99%, and this is up 120%. So again, outperformance both on going down and going up. One more example is MI20, which is a small and mid cap strategy. Again, you can see because small and mid caps are more volatile, the drawdowns are also sharper. The mid and small cap 400 index, which is the dotted line, drops by 45% in this period, Jan 18 to March 20. Whereas the mid and small, the MI20 strategy drops by 36%. So you've saved yourself a good, almost 10% here. And then on the way up, the benchmark goes up by 148%, and you go up by 220%. So a huge gain on the way up also. So both put together, fantastic results come out. So let me now take you through weekend investing portfolios at a glance. So I am presenting here 4 portfolios. NG 50/50, which is our free portfolio. It's a very good portfolio to sort of start to get acquainted with momentum investing, start to get acquainted with small case as a platform, and this is totally free to use. And the virtually there is no entry barrier. You could start it with as small as 500 rupees. What this does is this buys Nifty ETFs and gold ETFs, and every month it will combine them in a 50/50 fashion, because gold and equities are very, very strongly inversely correlated, and they complement each other very well as a hedge. So gold is a great hedge for equity, and you can put your lower risk money into this strategy, money that is not looking for higher risk, maybe, and is not wanting to be in the bank either. That is very, very suitable for this strategy, where let me just show you if I can on oops, let me play. So anyhow, let me go through these strategies, and then we can come back to I'll showcase the charts for you.
Sure.
So NNF 10 is one of our popular strategies where the universe is Nifty Next 50. So Nifty Next 50 is essentially the next 50 stocks after Nifty. So these are all large caps, but they are not in Nifty. They are in the top 100, and they are the next 50. So 51st to 100 stocks. So very, very liquid stocks and large cap stocks. And the rebalance frequency here is on a monthly rebalance. So once a month, we will rebalance the portfolio. What is rebalancing? It is basically resetting of the weightages that you give to each stock in that portfolio. And if some change in stocks in the portfolio, if it is happening. So maybe some stock may go out and another stock may replace it based on the momentum ranking that we have done. The ideal portfolio size here is 3 to 15 lakhs. You can start it lower and gradually build it up. And there is a subscription fee of 2499 per quarter or on a yearly basis. And these links I will also provide you in the description below, so you can directly go and see these strategies. Another strategy is MI20, which is the mid and small cap strategy. Here, the number of stocks are 20 versus 10 that was there in NNF 10. The underlying portfolio is the mid and small cap 400 index. So essentially all stocks are either mid caps or small caps. And the rebalance here is on a weekly basis. So every week, over the weekend, we will review the portfolio. If there's any change in weightage or if there's any change in stock, we will send the rebalance through the small case app, and you'll, with a single click of a button, you'll be able to execute that on a Monday morning. The recommended portfolio size here is 1 to 5 lakhs, and the subscription fee here is 1,666 for a quarter and 4,999 for a year. While there are different portfolio sizes recommended, most portfolios you can start at a lower level and gradually build it up. You need not bring in the whole lump sum in at one go. MI Evergreen is one of our very, very popular strategies. What we have done here is we have taken 20 stocks from the top CNX 200 list. So all are very liquid and top 200 stocks. And we've combined this with an allocation to gold. As I said, gold is a great hedge for equity portfolio. And the universe here is CNX 200. The rebalance is on a monthly basis. And the ideal portfolio size is 3 to 20 lakhs. The subscription here is 2,499 for a quarter or 7,499 for a year. And what we have seen in this recent fall also, that this particular portfolio has not dropped, even 10% of what the market fall has happened. So market has dropped 15%. This portfolio is down by like 1.5%, something like that. So a great hedge in terms of market weakness. But when the market is doing well, it will beat the benchmark even in that case. So more details on the strategies. So NNF10, as I said, Nifty Next 50 stocks. The total returns here in the last, I would say almost 6 years now, we've been running this since April 16. Total returns are 183% versus the benchmark having 102%. The CAGR here is 19.19% versus 12.6% on the index. And the max drawdown seen so far is 22% versus 42% on the index. So these are model returns. While you're doing your real investing, they may be off by a few percentage point, but more or less you will get that outperformance versus the benchmark. And you can see it in this chart, which is the last 6 years of chart, where the blue line is the Nifty Next 50. The dotted line is the Nifty 50 index, just for reference. And this is where the strategy has gone in terms of its outperformance. So it's a very popular strategy, good for concentrated large cap investing. MI Evergreen, as I said, large and mid cap portfolio from the CNX 200 stocks, rebalanced monthly, fixed allocation of 25% to gold. Total returns in the same period, 192% versus 106% on the benchmark, CAGR of 19.8% versus 13%. And max drawdown, as you can see, is much lower here, minus 18% versus 38%. Again, you can see in periods of market crisis, it is able to reduce the drops by a significant amount while outperforming on the upside. So MI Evergreen currently actually is also very, very popular, given that the gold hedge is providing a great support to the strategy. MI20, as I said, is a 20 stock portfolio made up of mid and small cap index. Total returns have been outstanding at 300% in the last 6 years versus 132 on the benchmark index, CAGR of 26% versus 15 on the index, and max drawdown at minus 38 versus minus 50. And the orange line is where you can see the performance of the MI20 index here. And lastly, this free portfolio that we have, which is a fantastic starter for a new investor, is a NG 50/50 investing in Nifty and gold ETFs. Our total returns here as well is 105%, which is very impressive given the low risk nature of this particular strategy. Of course, it versus Nifty, it has not really outperformed, but then it has not given you the whiplashes that Nifty gives you. Just if you can see this chart, the dotted line is Nifty 50, and you can see the kind of drops it has, whereas this strategy is pretty much smooth going all over. And you can see this in the drawdown here, where the max drawdown is only minus 21% versus 38.4% on the benchmark. So essentially what our aim in Weekend Investing is to empower you. We share a lot of content almost on a daily basis with all our viewers. We have a YouTube channel where we showcase a daily bite every day at 6 p.m., where we give you insights on several of our readings about the market and about what's happening in our products. Then Twitter is where we have 185,000 plus big family there, and there's a lot of discussion about the markets and stocks happening there all the time. We've also dedicated a Telegram channel where all of our subscribers are able to get any important information about the products or about any market related changes or some instructions or some rebalance instructions or some weekly reports that we share with them there. So that is a very important place for having a deeper learning about what's happening here. And the last but not the least, we have a Weekend Investing Hub, which is a library of sorts of all kinds of articles, FAQs, videos about how to use small case, what are the various nuances of small case, how to use the various features in small case, and what has been the performance and what has been the various facets of investing through momentum investing style. So over and above all this, we have a fantastic email support system, and we really take pride in the turnaround time that we are able to provide on the email support system. So these are some of the user manuals and videos just as an example, and you can see this that these links will be available to you in the description below, so you can go through them. And then lastly, I wanted to also show you how to subscribe. So when you will go to weekendinvesting.smallcase.com, you will come across all these strategies listed here. You can go inside each strategy, see the details, see the performance, and see how the makeup is done for these strategies. And then you can go ahead and subscribe to it using any of the 13 brokers who are empaneled with smallcase.com. So these are all the things that I had to share with you today. Many of these links you'll be able to see once you are able to get them in the description below. And thank you for your time. And Pranav, I can take some questions if you have.
Sure. Thanks a lot, Alok, for taking the time out. It was quite a comprehensive session. So before we proceed, I've actually made out a list of questions or queries that the audience might generally have.
Okay.
So we have spoken about multiple small cases today, and each having its own set of strategies. So I wanted to understand from an investor's perspective, how does the investor decide which strategy to start off with?
Okay, so essentially, the life cycle of an investor is such that if you are a new investor to the market and you really do not have much experience with the markets, I would say that you should start with simple strategies. So simple strategy would be like the free strategy of NG 50/50, where you will be able to get your feet wet over some time. What is the strategy doing? How is small case working? How do I rebalance? And once you have a handle over those things, then you can move to other strategies. For instance, MI20 you can go to, which is a small and mid cap strategy, has a lower starting range in terms of investment, or the MI Evergreen, where you also have a hedged portfolio. Mm-hmm. So these are some of these strategies, simpler strategies, which have lower volatility, which you can start with.
Mm-hmm. Okay, got it. And I also noticed that a lot of your strategies have a minimum investment amount. Mm-hmm. So minimum investment amount could be one thing, but the ideal investment amount could be another thing. So could you maybe shed some light on what the ideal investment amount should be for all these small cases?
So these amounts that I've mentioned here in the portfolio size, mm-hmm. these are actually the sort of ideal amounts. Mm-hmm. But minimum, I would say that for NG 50/50, you could start with 500 rupees. Mm-hmm. For MI20, you could start with 1 lakh rupees. For MI Evergreen, you could also start with about 1 lakh rupees. Mm-hmm. And for NNF10, you could also start with about 1 lakh rupees. So 1 lakh rupees is somewhat the minimum you should start with. But in case you're starting with that kind of minimum, you should have a roadmap of increasing it gradually, because otherwise the cost of the subscription itself will be extremely high on that 1 lakh rupees if you're going to just keep it at 1 lakh. So you must have a roadmap of taking it higher in case you want to start it lower.
Got it. So the next question would actually be one of the most common questions that we get from the audience. And this is, how long as an investor should I stay invested in any of these small cases?
So our sense is that just like any other long-term strategy, every strategy goes through its ups and downs, and there are drawdowns in every strategy, and the market cycles are such that unless you are planning for 3 to 5 years at least, you may come in to the market at a point where it may not be in a bull phase for the next year or two, for instance. So people who entered, let's say this year in January, are already in some sort of a drawdown. And the markets may stay sluggish for the rest of the year, and the next year it may improve, and the real fruits of the gain, if the market does go back up in 23 and 24, will take 3 or 4 years for them to really get that juice out of the market. So my sense is, not try to time the market, but come in with very long-term horizons, very long-term roadmap for investing, because you don't know which is that 1 year which is going to give you that bumper profit out of the next 10.
Right. Got it. And could you maybe also throw some light on how rebalancing works in all these small cases? What kind of churn rates can we expect, and why rebalancing is so important for an investor?
So rebalancing, as I said, is a review of the portfolio, where we are reviewing whether the stocks that are already there in the portfolio need to be changed, if at all, or the weightage of each stock need to be changed at all. So that is the purpose of rebalance, to keep the portfolio current as per the model portfolio, which is running as per a strategy in place. Now, let's say some stock is going down and the rebalance happens. Most likely than not, that stock will be dropped, even though it has gone down, because in a momentum portfolio, you want to stay with the strength in the market and not the weakness. And a new stock which is showing strength will be brought in. So a notification comes through you through the small case app, or you can do it on the small case desktop also. And just with a couple of clicks, you are able to send that rebalance to your account, wherein the account will your small case account will tell your broking account that sell this stock and buy this stock, and that is the end of it actually. So there's nothing much to be done except a few clicks, and the rebalance makes sure that your portfolio, which is in your broking account, in your total security and control, remains in sync with the model portfolio which the small case manager has proposed.
Got it. In my next question would be one of the most common queries that actually come through from investors as to whether they should go ahead with a lump sum investment, or should they take an SIP route. So maybe could you highlight on some key important factors there?
So either way, there is no one way which one can say that is the right way. But usually what happens is that, since we are not trying to time the market, we want to come in with our capital very, very gradually and spread out over time. And that can happen with the SIP method, wherein most people are, in some sort of a situation where they get monthly income, and they're trying to save some part of that monthly income and invest into it. So most of the people actually do not have lump sums. They are able to do only SIPs. But if you have lump sums, you could do an opportunistic lump sum investment based on the market conditions. So if you find that the markets have taken a good dip, maybe 15% down, 20% down, and there is no one right point for it, that's where you can sort of plug in a good chunk there. The SIP method, however, is very, very peaceful method, and it makes sure that you are able to average out your entry point into the market. Even though you may have started at the topmost highest point, by the time the next cycle comes around, it won't matter where you started from. So my suggestion is but if you can make opportunistic invest more decisions as well.
Got it. Okay. And you've spoken you've spoken about outperformance in both downward trending and upward trending markets. So what if we encounter a choppy range bound phase for a very long time? How are these baskets expected to perform?
So the weekend investing baskets are actually of two kinds. We did not go very deep into momentum investing, but there's something called absolute momentum and there's something called relative momentum. Absolute momentum strategies, when they witness a fall in the markets, go to cash. Whereas relative momentum strategies, as the name suggests, they will rotate within that particular universe and go towards the defensive stocks in that sector. So in both these fashions, when the markets are choppy or going down, the movement of capital is towards safety, either to cash or to defensive sectors. So there can be periods of time where the market is range bound or sideways, where these strategies may not outperform. But as you can see that 80 to 90% of the time in the markets is spent in either an uptrend or a downtrend. And if you are able to perform on both those metrics, then overall you come out winning on the overall return comparison.
Right. Got it. And I can notice that many of the small cases as displayed on the screen have a recommended portfolio size of what has been mentioned there, and the minimum portfolio sizes of most of these small cases starting from 1 lakh onwards. Yeah. So let us say that there is an investor who wants to start off with 50,000 rupees of investment. Considering that the annual subscription fee is 5,000 rupees, which roughly translate to 10% of the total investment amount of 50,000 that the investor wants to make. So can the investor actually make returns over and above the expenses in such a condition?
I would suggest that, if the investor does not have the minimum investment, is that they go for, let's say, the free small case and gradually try to accumulate their money there. And once they have crossed the threshold, which is required to come into the larger small case, that they then move the money from there to here. Because, even if the small case does allow you to come in with a smaller initial amount, the fee and the cost, etc., may not justify, coming in with a smaller amount. So I don't want anybody to come in and, spend 5-7% of their capital or just on the fee, etc. Right. So you must choose the product which is suitable for your capital and your risk profile.
Got it. So one last question from me would be as to whether you have any plans of launching any new small cases with new strategies going forward in the future.
So we have launched several small cases over the last 3 years. Every year we have launched a few. And in the same tradition, we will look out for newer strategies in the future. But right now, there is no plan to introduce more strategies because we have a large bouquet of strategies in place which are really doing well. And there is currently a lot of demand for, MI Evergreen, MI NNF10. And these are strategies which can, really accommodate a lot more people, although we have already 16,000 or more investors, but we can accommodate a lot more investors because these strategies are built on large cap stocks. Right. And in large cap stocks, there is really no limit where we can go to. So while we will look out for newer strategies, but for now, these are the main strategies we are focusing on.
Sure. All right. So in that case, what we would like to do next is to actually show the audience how the audience can identify where weekend investing's portfolios or small cases are positioned on the portal. So what I would like to do next is to actually take the audience through the flow. So first, you will head over to smallcases.angelbroking.com. So over here, please make sure that you have logged in using your Angel Broking trading and demat account. So there are no additional steps when it comes to picking up a small case basket using your Angel Broking account. So first thing to note is that all the set of stocks which are purchased are directly purchased in your own trading and demat account. So you will be holding these stocks in your Angel Broking trading and demat account. So to find out where weekend investing small cases are present on the platform, head over to smallcases.angelbroking.com. Over here, you can click on Discover, and then you can click on Managers. So over here, you will find Weekend Investing, displayed over here. Please click on Weekend Investing, and then you can click on See All Small Cases. By doing so, the screen will display all the available small cases which have been listed over here. So if you wish to invest in any of these small cases, or if you wish to subscribe to them, you can feel free to click on the small case of your choice, and then you can click on the Invest Now button and go through the step-by-step journey that is being displayed on the platform. So this is all about weekend investing, and we have heard it from none other than Alok Jain, who has agreed to come over to the platform and share his experience over here. So if you have any other queries, you can feel free to reach out to Angel Broking. It could be with respect to the subscription flow, it could be with respect to charges, it could be with respect to any support that you need at the time of subscription, and Angel Broking will be able to assist you promptly. So with that said, I would like to thank Alok Jain from Weekend Investing, and also thank Angel Broking for having this session.
Thank you very much, Pranav.
Yes.
Thank you.
Thanks a lot. See you also.
Bye.
Thank you. Bye-bye.